A new regime is here. I'm your host, Steve Van Metre, and thanks for joining me today. And Blackrock, the world's largest asset manager, just released its 2023 global outlook, in which it indicates that the global economy is now under a new world order. And in this new world order, it suggests that when the recession hits, which it makes the case is highly likely next year, the investments that you've typically used to protect yourself will no longer work. As BlackRock indicates in this publicly available report, that a new investment playbook is necessary, and it's a good thing we have them to guide us. But the real question we want to address as we take a look at this report today is not what if BlackRock is right, but what if they're completely wrong? Let's head over where we picked today's story up with, again, the 2023 Global Outlook provided by BlackRock. Again, this is publicly available, so you can look it up and get a copy and take a look at it. But I want to go through pieces of this and try to put this in perspective, because I think their analysts are saying that we're under a new normal here, and I completely disagree. It starts out by saying the great moderation, the 4-decade period of largely stable activity and inflation, is now behind us. And of course, this first sentence is worth challenging to begin with. So we look at, we've had 40 years where inflation has gone down steadily, it's slowed. It has not, I don't mean it's contracted, it just means the rate of growth has slowed. The global economy has expanded. And now, because we have a global pandemic, we have a response, unprecedented response of fiscal and monetary stimulus, that somehow now that changes the entire world. That was all we needed to disrupt this 40-year trend. The case I want to make today is, what if the anomaly was the pandemic and the trend is coming back and people don't even realize it? The new regime of greater macro and market volatility is playing out. A recession is foretold, which I'll agree with. Central banks are on course to over-tighten policy as they seek to tame inflation. Now, central banks, of course, they always get a bad rap, and on this show, we like to pick on them because, well, let's just face it, they're a really easy target. And by their own design and by their own data, central banks always over-tighten. And the reason they do is because they don't look at leading indicators. They look at lagging indicators, and they're very poor despite their large number of PhD economists, at least the Fed. They have more on staff than anywhere in the world. They can't seem to look forward and start to put some trends together. So the idea that this is a surprise, the Fed is going to go too far, well, we already know the market has suggested that now, but they've done it again, and it will be a problem. This keeps us tactically underweight developed market equities, but let's fast forward here. They are not there yet in terms of where they see risk assets turning. And when we get there, we don't see the sustainable markets of the past. That's why a new investment playbook is needed. Now, on the Sunday show, and I know this is not a show that most people watch compared to the regular ones, we talk about how the algorithm, the formulas, how the market actually works. And what a lot of people don't realize is that following the great financial crisis, a lot of asset managers, very large asset managers, pension funds, insurance companies, they were nearly wiped out. Now, I know you didn't see some of this because of all the government bailouts, but they were very close to seeing events where they would be forced to sell. Now, what has changed since then is everyone's decided to make trend following algorithms of some flavor or another that essentially say, if market goes up, you keep buying. If market goes down, you sell. So the notion that we're not going to see sustainable markets, that's not the case at all. If momentum, if the price starts to move higher, all these machines, and there are trillions of dollars backed by these, start to move, it will push the market what direction it wants, regardless of what the data suggests. So here in this case, BlackRock, well, I just don't agree. But when we look at from the inflation perspective here, and this is one that the case is being made, particularly also by BlackRock, that we're under a new regime of high inflation. And when we take the consumer price index here and just look at the monthly percentage change, I want you to note that typically it runs around 0.3%, maybe upwards of 0.4%. And this puts us at very moderate inflation on a year-over-year basis of around somewhere between 2.5%, maybe 3%. 2%. In some years, it's going to be a little bit lower, but this puts us on track for kind of just a moderate pace of inflation. But you'll note here in the 1970s through 80s, we had sustained inflation, but look at the monthly changes. And not only did it go up, but when it came back down, it stayed rather elevated and continued to push higher. Here we saw this big move higher, and now it's pulled back. Prior month, there 2 months ago to 0, then up to 0.4. Now, of course, we're going to get the CPI report next week, but if we just maintain, say, a roughly 0.3% monthly change, that means inflation on a year-over-year rate basis goes back near 2%. So we don't have to have big numbers of inflation. We just have to have it come down to a more moderate level. And of course, we've made that case on the show this last week. Remember what we talked about? We talked about container volumes, freight volumes collapsing, container shipping rates collapsing, used car prices collapsing, gasoline prices back at nearly 0% year-over-year growth. So we're looking at all these cases to say perhaps this new regime of high inflation that people have been banking on and counting on is just not going to happen. Here we could look at, of course, the claim BlackRock has about the bond market. We'll see that coming up in their report, that interest rates are only likely to stay high. Well, we've seen this chart or similar one that we've looked at on this show, where we have the yield curve, the 10-year Treasury minus the 3-month Treasury yield shown in blue. And what we can note is when it's inverted below this black line, what we see is that long rates are usually either at a peak or a near-term peak and heading lower. And we see that case over and over and over again. So here again, the idea that interest rates are not coming down here or cannot come down, there's just no historic evidence to suggest that. Of course, the question we should be asking now is, why is BlackRock making these claims? Well, we'll get to that here soon enough. Central bankers won't ride to the rescue when growth slows in this new regime, contrary to what investors have come to expect. And again, there's zero historic evidence for this either, because if indeed inflation comes down and perhaps even goes negative, which we'll make the case for here shortly, then yes, central bankers will come to the rescue. And when do they do it though? Well, they come too late. And why do they always come too late? Because they look at lagging data. So you see, it kind of comes full circle. So maybe the case BlackRock's saying is, hey, look, inflation's going to stay high. There's no way central bankers are going to show up. Now, don't worry, they'll show up. But oftentimes, as we've seen in history, way too late. They are deliberately causing recessions by over-tightening policy to try to rein in inflation, and that makes recession foretold. We see central banks eventually backing off from rate hikes, which we'll start to find out next week. As the economic damage becomes a reality, we expect inflation to cool, but say persistently higher of targets than 2%. And again, I'll disagree with the 2%. We'll make that case here momentarily. But the idea behind central banks over-tightening to deal with inflation, well, you think about it, there's really only two ways to deal with inflation. Either you let the market forces balance out by saying, look, we have high inflation right now because we have a supply shortage. So how do you handle that? Well, we need people to come back to work and create more supply. And what way does that work? Well, you let wages rise. Of course, we know the Fed, as we've talked about on the show, does not want you to get big raises. In fact, they prefer that you lose your job, and because the Fed can't control that. But what they can do is reduce the rate of credit growth in the country, in the financial system, and stall that out until people lose their jobs and they consume less. And that's the only tool the Fed really has. And well, there's a reason. It actually does work, because a lot of people can't accept the idea that if we just let inflation run, the supply and demand will balance over time. If you want to know why we can't do that, or at least why politicians will not accept that, because about half of all Americans will get left far more behind than they already are now, and they won't like that. And usually at some point, that means the people in power get voted out, well, and they don't like that either. But as far as making the case for inflation coming down, we look at this chart here of the consumer price index in blue against U.S. regular all formulation gas prices in red, and we notice there's a very strong relationship between gas prices and inflation. And gas prices are hovering just above 0% year-over-year rate of growth, indicating that, as we've talked about on the show recently, this should coincide with around 2.5% year-over-year headline inflation. But the problem is going to be is when we strip away the inflation inflation chart and just look at gasoline prices, you go back to this summer and you see prices were up near $5 a gallon. Well, in order to keep this at a 0% year-over-year comp, that means gas prices need to go back up to $5. If they stay at their current level, or even worse, they go back down into kind of maybe around 3.25 a gallon here where they've been in the past, what this suggests is a year-over-year comps, my friend, so they're going to be negative. And then those negative prints start to feed into the CPI, and you start to make the case of why inflation's coming down. And of course, that's how we know the Fed's come to the rescue at some point. And we also know this because the bond market's been telling us the same thing. So here we take a look at that 10-year, 3-month yield curve, but we're going to invert it, showing in red. And I drew that baseline up here. And we can note is when the curve's inverted, it signals that inflation is either peaking or at a near-term peak as we head into a recession. So here we can see in the late 80s, it didn't peak, but it signaled it was not far off. Here in 2000, signaled a peak. Here in around 2006, 2007, we didn't have a peak of inflation, but it foreshadowed the eventual peak. And here again in about 2018, we saw again a peak kind of coming close to the peak of inflation. And here we go again. So everything we can see here, and I'm not sure why Blackrock doesn't look at the yield curve or make a case for it, but it's telling us that inflation, at least in the near term, may not have peaked, but it's very close. And the prediction that the market has is it's coming down. In that case, we know that we're not under a new regime change. Perhaps the anomaly, and this is what I want to suggest to you in today's show, perhaps the anomaly wasn't the 40-year period. Perhaps the anomaly was just simply the pandemic in the response to it with this outrageous amount of fiscal and monetary stimulus. You strip out both of those stimuli, which we've stripped out one of them, the fiscal's gone, and we're stripping away the monetary rapidly. Well, what do you have left is a potential where you have an equal and opposite contraction to balance this out back to normal. But apparently BlackRock says, that's not going to happen. What matters most, we think, is how much of the economic damage is already reflected in market pricing. Of course, the yield curve would say that is what is to come. Remember, the yield curve is forward-looking, not backwards-looking. BlackRock says, yet we won't see this as a prelude to another decade-long bull market in stocks or bonds. But reality is, you think about the economic damage coming here, that is a prelude to a long run in bonds. You see a big sell-off in stocks, and then what will happen is eventually these machines will start to turn around. You'll see prices start to go up. You'll see momentum build again, and you'll see the economy recover. We see this happen over and over. What we don't know, what we not with certainty can predict, is just how bad this next recession will be. Will it just be a mild recession? Will it be a financial crisis? Some of you agree that it could be as big as a depression. And again, it will be strictly a response to withdrawing massive amounts of fiscal and monetary stimulus. But yet we have this view that because we didn't have increasing inflation for 40 years, we had disinflation, that we must. There's just no way around it. We must have inflation now. But the reality is that's not the way it's going to eat. This new regime calls for rethinking bonds, our second theme, as they say higher yields are a gift for investors who have long been starved for income. And yet, what do we hear from investors? Oh, I want higher yields, I want higher yields. And yields went up, and what do? They're selling bonds. They're not buying them, they're selling them. And then notably, they're buying short-term bonds, when they probably should be looking at long-term bonds, which is quite odd. They go on to say that investors don't have to go far up the risk spectrum. They like short-term government bonds. And, well, I don't know about you, but BlackRock likes mortgage securities, maybe because they want to unload them. But I think the last financial crisis should give you reason to pause. On the other hand, they think long-term government bonds won't play their traditional role as portfolio diversifiers due to persistent inflation. We see investors demanding higher compensation for holding them as central banks tighten monetary policy at a time of record debt. And yet there's absolutely no correlation between the amount of debt and rising interest rates. In fact, we've shown on this show, I think years past, that the more government debt, more debt a government takes on, the lower interest rates actually go. It's because what's happening is the bond market is saying, look, due to the government having such a big size of the economy that it has to service this debt, that it is sucking away future growth and inflation trends. That's why you see yields fall. But again, BlackRock says yields are going to stay high. Well, no. Again, we come back to that chart we looked at earlier, the 10-year minus 3-month yield curve. And again, we now overlay 30-year treasury yields. And again, you see the inversion, yields fall, inversions, yields fall, inversions, yield fall, inversions, yield falls, inversion, yields, and inflation are coming down. So that's why you see, when we talk about the research, as you know, some of you know, I go on my friend Jeff Snyder, also one of our partners here, and we go on his show every Saturday. And what does he talk about? Foreign private investment in the long bond, long U.S. Treasuries, not intermediate, not short-term, long bond is at record levels over the last 6 months. And not just slightly over the record levels, but way past the prior records. Why? Because they get it. Our third theme is living with inflation. We see long-term drivers of this new regime, such as an aging workforce, keeping inflation above pre-pandemic levels. We stay overweight inflation-linked bonds on both tactical and strategic level. And again, you get to the whole notion that inflation, because of the boomers, is now going to be persistent because they left the workforce. But you have to understand that, it's like a teeter-totter. You change the balance on one side, something else changes. So looking at the workforce, what were things that boomers did? Well, they bought cars to drive to work, and many of them had 3, sometimes 4 cars. Well, in retirement, you don't need that many. And where did they go every day? Well, they went to an office. Well, we see that trend changing due to the pandemic. And what did they do before they got there? Well, they put on their work clothes. They stopped and bought coffees. They bought breakfast. They went out to eat. They did all of these things, and now they're shifting into retirement. Their budgets are changing. They're worried about the stock market, and they're switching into things like leisure and activities, health-related things. And what will happen is the economy will eventually rebalance, and as demand for these other types of work, say boomer closures, go away, those stores will close because they don't need those work clothes. Those people that work there, had those business, will shift to things maybe perhaps like boomer healthcare, where there's more money. And that's always how you see the economy and inflation balance out. It's not overnight. It doesn't take, it's not a matter of months. It takes time, but eventually it all balances out. Our bottom line is this new regime requires a new investment playbook, and thank goodness we have Blackrock to help us, as it involves more frequent portfolio changes by balancing views on risk appetite. So I think the real issue here, as we take a look at this Blackrock report, is what no one's making the case for is, what if the world returns to normal? What if the pandemic was indeed the anomaly? And what if long-term interest rates do come back down? What if inflation does come back to a normal trend? What if central bankers are indeed wrong, as they always are, and over-tighten? Perhaps the answer is we don't really need a new investment playbook. Maybe the answer is we just need to stick with the existing one and let the course of supply and demand rebalance them, and realize that the actual base case now is a pretty severe recession in 2023, which of course will bring back all those traditional portfolio models right in line with where they need to be. But we'll keep an eye on Blackrock and see if they're right. But as for me, I don't agree. I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.